Good afternoon and welcome to U of T Mississauga's first time Homebuyers Bootcamp. Before we begin, I'd like to share a little bit about my background. My name is Sarah Gergis and I graduated from UTM in 2019, and I'm so happy to be here today representing my fellow UTM alumni. After graduating as UTM's class of 2019 valedictorian, I started my career as an external auditor at KPMG Canada, where I obtained my Chartered Professional Accounting, or CPA, designation. I then joined Deloitte's Finance and Performance practice to continue my career in one of the best consulting environments. Today, I'm a senior analyst for Canada Life, and I currently also hold a sessional lecture position at Rotman Commerce, where I teach the Advanced Managerial Accounting module. And now, although this event takes place online, I'd like to take a moment to acknowledge this land on which the University of Toronto operates. We start by acknowledging that we are on the traditional territories of Treaty 13A, 14, 19 of the Mississaugas of the Credit First Nation and unceded territories. We are grateful to the Mississaugas of the Credit First Nation as the caretakers of this land and recognize the benefits we receive from this land. This land continues to be the home for First Nations, Inuit, and Métis people. We thank them and other Indigenous people who have walked before us and share this land with us. Over 800 alumni and friends have registered for today's webinar, which shows what an important topic this is to so many of us. Following the presentation, there will be a moderated question and answer period, and we encourage you to submit questions using the Q&A button at the bottom of your screen. If you're having technical difficulties, please use the Q&A to send a message, and one of our staff will respond privately to you. The chat function on this webinar will be disabled so that we can keep focus on today's event and content. Now, I'm delighted to introduce our presenter, Shant Kaltakjian. Shant is a proud U of T alum, completing his Bachelor of Business Administration in 2004 at U of T Scarborough. He's a managing partner and broker at Dominion Lending Center's Mortgage Watch, Inc. Over the last 17 years, Shant has helped over 1,000 clients achieve their dream of home ownership. Shant has also helped his clients build wealth through investment in rental properties. He's a believer in real estate as a key component to building long-term wealth and retirement strategy, and ensures his clients are routinely reviewing their mortgage plans to help them reach their financial goals safely and efficiently. So now, without further ado, we welcome our guest speaker. Take it away, Shant.
All right. Thank you so much, Shara. I really appreciate the opportunity to be here. And I just want to make sure this is up right. All right. There we go. That looks good. All right. Thank you again, guys. I appreciate the opportunity, the privilege to be here to share some insights, my experience. It makes me think back to when I bought my first property. It was back in 2005, shortly after I graduated. I grew up in Scarborough, and I remember it was a pretty nerve-wracking experience. So, the goal today, of course, is to share the experiences that I have, that my clients have had, the successes, help folks get prepared, and really, be ready for when the time's right for folks to move ahead in their home buying journey. So, let's get started, and I'm just going to cover a brief agenda. So really, again, role of a mortgage broker. We'll get into that, of course. We'll talk about building your team of professionals. There's a few key players in this department, of course. We'll obviously talk about some financing, what we need to get prepared, talk about, doing some homework, what's needed. And then we're going to review a few scenarios that will just help paint a picture and give folks an idea of sort of, how all the numbers can shake out. I think it'll help answer a lot of questions. We'll, of course, talk about some new mortgage rules, which are ever evolving. So that will be something we'll quickly touch on. And then we'll end on sort of some next steps on what folks can do to move ahead in their home buying journey, and what's needed to help them succeed in that plan when they are ready to take that step. Okay. So as we get into it here, I would say there's about four key players in definitely building your team of professionals. So, number one, having someone help you through the mortgage process. A broker is definitely a specialist in this department. Figure out obviously what's needed to get prepared, give you the insights needed, of course. A realtor, real estate agent, right? Helping you access properties, understand different marketplaces, different types of properties, and really give you insight on the property types, locations, different details needed for that. Buying a property involves having a lawyer, right? A lawyer is the person who makes sure, title is transferred properly into your name. They take care of all those details. You definitely need a lawyer involved. They're an important piece of the puzzle. They handle the paperwork from real estate agents. They also are the ones that help bring all the financing together at the end, working with, the mortgage provider to make all that happen. So you get your keys, of course, at the end of the day. And then having a home inspector is also a key person in the picture. So that person will help analyze and assess the property if it needs repairs, different things to look out for in that regard. All right. Diving into a bit more as far as what a mortgage broker does, sort of their value proposition from a very high level. A broker is someone who absolutely can help someone save some time, money, maybe even some aggravation, but really just lay out the process and help clients understand sort of where they are, where they want to go, and more importantly, help them make the most informed mortgage choice, right? So many different options available, different providers. What's the difference? Which one makes sense for you? Definitely having someone on your team will help with that. So again, diving a bit deeper into this, a broker number one will give you unbiased advice. I used to work for one of the big banks as a financial advisor. So, you know, me being a broker or anyone that is a broker, they are not an employee of a provider. So they're independent. So what that means is that they can be completely unbiased and really focus on where you are today, where you want to go tomorrow, and help you size up the different available options. But until we know where you are and the game plan going forward and have clarity on that, then we can bring the relevant options to clients so that they, can really make the best choice for them. Okay. So regardless of the provider that, sources, funds that mortgage, we really create a match once we have, again, clarity on where the customer is. We bring the relevant options to clients. And at the end of the day, it's, the client's choice on where they're going and why they're choosing the provider, because we've given them all the relevant information in deciding on which contracts align best with their goals. So, unbiased advice is number one. Giving clients more choice, of course. So a broker will work with major banks, credit unions, and what we call monoline providers, also known as mortgage finance companies. So these providers, the mortgage finance companies, are all reputable Canadian companies. They don't have, local branches where it's bricks and mortar. Everything is sort of done online. Very safe companies. They deal exclusively with mortgage brokers, offering innovative products. So definitely a consideration for anyone looking to get into home ownership. You want to be able to have all the relevant choices available and then go with the option that aligns best with your unique goals. There's never a one size fits all. Okay. Um, Next, getting into, having an expert by your side. They can share advice, knowledge, experience. Um, you know, a broker will definitely, help many clients throughout the year, and really, experience different scenarios and, not to say that I've seen it all, but helping clients really through any questions, guiding them through the experience, what they need to do. So dealing with a specialist is key, of course, and really just making sure you have a deeper understanding and know all the bits and pieces, of course, to be ready so that when the time does come, you know what to expect. And a broker who's helped clients have, a successful experience will be able to share, those successes and I know when I first started, I made some mistakes as well too. So, making sure clients don't make mistakes and really just help manage that process. So dealing with a specialist is key. Ongoing mortgage management, long-term relationship based. So this just speaks to a mortgage broker will obviously help you get prepared. So before you start, your journey, doing the preliminary work during your journey, being there to guide you along the way, help you crunch any numbers. but also a good broker will help you manage your mortgage afterwards. So doing annual check-ins, being that same point of contact to help you um, with any questions along the way, provide market updates, give you the insight needed, and just be that same person to help you navigate things is what clients I think really enjoy as well. Having that same person there from the beginning through the different stages is something that I found clients really enjoy with a broker, right? Having that same point of contact. All right. And then the last piece here that I wanted to mention is many people may think or wonder, like, this all sounds like a great idea. How does a mortgage broker get paid? How do they earn a living? How does this all work? So the way that it works is all these lenders, these providers, the banks, the credit unions, and these different providers, they're all looking for new customers. So when working with a broker, when we end up making a connection with a provider, the brokerage is paid a fee for the introduction of a high quality client. So the way that that works is lenders are all, again, looking for market share and new customers. They definitely want new mortgage clients because it definitely is part of their offering. So if a client can get set up with a provider um, and a lot of the pre-work is done, then that lender is obviously very excited to have that mortgage client. And mortgages are considered an anchor product. So if a provider can get a new mortgage customer and maybe their other banking needs aren't taken care of, that provider is now excited they have a new customer that they wouldn't have otherwise received, that they could potentially offer additional products or services to and also have that mortgage, renew with that provider, which may be good, may be bad, but that provider is hopeful that they have a new customer that they can retain for years to come. But again, a good broker will be able to be there in your journey to help you look after a renewal and so forth. But there's definitely no cost. It's a total win-win for clients. So working with a broker is definitely something you want to consider. Okay. And as we get further into this here, the whole rent versus buy. So which one is better in the short and long run? I mean, renting is definitely something that is a good thing, especially if someone is unsure of what sort of specific area they're going to be living in or where they want to live. So, having a rental is great because you can test drive sort of living in different areas and see where you want to be before you commit for the long run as far as investing in ownership. So renting is definitely something to consider, especially if you're not sure in different areas. Doesn't allow you to make a long-term commitment. Okay. Well, we're going to get into sort of what I can afford. There's affordability rules, which we'll dig deeper into as far as what we, could qualify for and look at, how much, again, we could qualify, but then of course what everyone's personal budget is, and everyone has different comfort levels. So there's some rules around it. I'll be providing some shortcuts as well. And then managing, lifestyle expenses, asking yourself questions on getting a new car, daily Starbucks, you know, really we'll dig into understanding sort of where your money is going and maybe, doing some budgeting exercise to see in reality where everything is and how to make best use of your money. So that's something that we'll dig deeper on as well. And then lastly here, goal setting, really just getting started, feeling empowered to take the first step. So goal setting is a big key to figuring out where you want to be, where do you want to live. So let's just keep moving forward here, and I'm going to get into financing. The question is always sort of setting the table around what are the four pieces of sort of a pre-approval or financing puzzle. And item number one is understanding someone's income. So we'll talk about that as an important piece. We'll get into, of course, a down payment, what someone's resources are. We'll talk about credit history, of course. And then lastly, sort of the property is an important piece of that puzzle. All right. So getting into the income side of things, the question is, how is someone employed? Are they paid a salary? Are they hourly? Do they work for themselves? How does that matter? And, working with a broker, of course, will help figure out, what options are available and how you're paid and how that translates into sort of getting qualified. So some sample documents. Here, a job letter, a pay stub, T4s, especially for someone who's salaried or hourly, are popular documents that will be needed. Um, and then also someone who has their own business, let's say, something called a T1 general, also called tax returns, notice of assessment. These are sort of important tax documents that if you are self-employed, you want to be able to have those readily available because they'll be required as far as, getting prepared in financing. And looking at sort of a shortcut here, a quick calculation is what's written. So to figure out sort of what someone could qualify for, you can take your pre-tax income, multiply it by a factor of 4 to 4.5 times. So in this example, if someone's income is, $100,000, they could look to borrow up to 4.5 times that. So 450K in financing. So this will help sort of answer a few questions on what some preliminary boundaries could be. And the idea around the income is, figuring out obviously borrowing capacity, but going through this process of sort of a pre-approval, understanding your income and what's possible is, again, really understanding those borders and boundaries, because it could definitely help open up a few more different sort of property options. Buying a property closer to your work, spending less time, or excuse me, spending more money, let's say, in a higher purchase price and monthly payment may not sound exciting, but if it ends up benefiting someone where they perhaps get into a better location, they could save time and money in commuting and maybe not have a car payment, that could be rationalized into the conversation to help people really understand sort of where and what their options are, as far as the financing and what property you can get with it. And then the other option is renting a portion of the property. So um, this is something that even for your first home, whether it's a two-bedroom condo perhaps, and you're comfortable maybe renting a room to a roommate, could be something to consider. Obviously, that's not necessarily built in to the financial picture, but if there was a property that had a separate, basement apartment, for example, that could easily fetch, a certain amount of income, then we could look at that in the picture as well to help augment, the budget and explore options. Okay. As we move forward here, the second item up for bids in the scenario is looking at someone's down payment. So lenders want to know where your funds, your down payment funds are. Okay. And, down payment funds and of course closing costs. So examples of what a mortgage provider would be looking for is essentially 3 months worth of, bank statements. So it could be checking, savings accounts, investment accounts, including any RRSPs. And then here is a gift letter. So if funds are being provided from a family member as a gift, there's templated gift letter that's provided, that parents will sign, just acknowledging, hey, I love my son or daughter. I'm going to be handing over X amount of dollars that will form part of their gift. So a gift letter is something that could be involved in the process as well. Okay, so this is the down payment side. And here's something to consider whenever I'm having conversations with clients. A good broker will definitely help assess, how you can sort of optimize the funds that are available towards your down payment. So looking at a few big ones here, a first homeowner savings account. This was started in 2023. This is an account that allows you to contribute up to 8,000 per year into. There's a lifetime amount there as well. And you can claim these contributions. They're deductible against your income. So similar to an RRSP, and any income or growth in this account, because you open this account, you make, a contribution, and then you can, of course, invest this money to help it grow. But you don't, want to be too aggressive with it. But whatever it's invested in, whatever growth or income it produces, that's yours, tax-free. So this is a really good option for clients to consider. There's some tax benefits, and just again, it's been put in place to help people grow their down payment quickly, create some value. A tax-free savings account is the next one. And this has been in effect since 2009. So there's annual limits for this. Um, Amounts contributed into this account are not deductible. So that's a big difference from the first homeowner savings account. But what is similar is that the income and growth is tax-free. So anything that grows in here whenever the funds are withdrawn, there's no tax on that. So that's great. And then lastly, I think one thing to consider is a re registered retirement savings plan, an RRSP. So there is something called a first-time homebuyer program. And this type of account, so an RSP in general, will allow you to make contributions. And the contributions are deductible, similar to a first homeowner savings account against your income. Okay. And then being able to use that money towards your down payment. So before I dig into that, there's just one change that I want to make sure I don't forget. But it used to be that this RSP first time homebuyer program, you could withdraw up to 35,000. That's been increased to 60,000. So if there's two people that are first time homebuyers and they've stuffed and contributed money into their RSPs and it's grown up to you can withdraw up to 60,000 each. Each individual could do that. So that's a healthy amount if someone's been able to build up their RSPs to that level. And then again, something similar, any income or growth in an RSP is tax-free. And, the last point here, as far as using the first-time homebuyer program through RSPs, is any money that's withdrawn has to be repaid within 15 years. Otherwise, it becomes added to your income and it's taxable. So whenever someone is looking to someone can, number one, look to top up before I forget if they have the available room in their RSPs. You can look at that notice of assessment when you're doing, income taxes or chat with an accountant. It'll tell you how much room is there. It's typically a percentage of your income every year, and there are sort of unused contribution rooms. So you can look to move some money around that is not in an RSP and maybe funds that haven't been put into a first homeowner savings account may be worth considering making a contribution, getting the benefits, and then look to withdraw those monies tax-free. So if someone is going to use this program, what we highly recommend is working in what that monthly payment would be going forward. So if someone was able to, contribute and again withdraw 60,000, they'd have to work in a $330 payment into their budget because they have to contribute. We recommend monthly just for budgeting purposes to put back into an RSP. So at least that's sort of woven into your budget. So these are, I would say, some top programs to consider for anyone a first-time home buyer to explore and see which options make the most sense for your scenario. Okay. Moving forward, getting into credit history. So there are two main suppliers of credit history in Canada. One is Equifax, the other is TransUnion. So there's what's called a credit score that you're given. Anyone who's had to rent an apartment or something will typically a landlord would want to see someone's credit history. And you're given a score as well. The score can range anywhere from 300 to 900. So ideally, an average score is 650. And ideally, we want clients to have the higher the better, so to speak. And, a score of 720 or more is sort of an ideal place to be. And really, this score, again, represents the perceived risk to a lender when they're assessing credit. And to go a step further on the credit history, there's essentially five pieces of the puzzle. And I think when Sarah did her financial literacy webinar previously, it spoke to these five sort of drivers that make up the score. And one is sort of the type of credit that you have. So whether it's a credit card or a line of credit or like a cell phone. So cell phones will, cell phone bills, you want to make sure you're up to date on those because those will show up on your credit history. But the score is determined by the type of credit you have, and the mix, I should say, and what's called how many trade lines. So how many credit items do you have? You know, do you have a line of credit, a Visa, an Amex, a student loan, a car loan? Having a mix is good. Ideally, you want to have what's called 2 trade lines or more with a history of maybe 2, 3, 4 years plus. That will definitely help establish your credit a bit more. The other driver is how long you've had credit for, right? Having it for more than a year would definitely be beneficial. Lenders are looking for that, and the score obviously is dependent on that. And credit limits is something specific to credit limits is also what's called credit utilization. So if someone has $10,000 in available credit between a line of credit or a credit card, if they have a balance owing of, let's say, 5,000 and their total limits are 10, the credit utilization in that scenario is a 50% sort of level. And that's where you want to be careful, because anything above 30% of this credit utilization will slowly take away from someone's score. So understanding sort of where you are, maybe managing, you know, a debt reduction plan to get within those limits will ideally, you know, create a better score. So the third item with credit history is understanding your credit. Let's look at it. Let's make sure there's no surprises, and let's see how we can improve it as needed. Okay. And as we dig further into this, the final piece. So we talked about someone's income, we talked about down payment, we talked about credit history. So the last piece of the puzzle, you know, once we get a handle on those first 3 items, we'll be able to again sort of paint a picture on what's possible, what type of properties can we consider. And here's a list of you know, the different property types. Condo townhouse. You know, condos typically have, you know, a maintenance fee, and that maintenance fee goes towards covering the maintenance of the building, hence the name. Typically covers water. It could cover some other utilities. So every property will have a different sort of level of maintenance fee. You know, typically newer properties could have a lower maintenance fee. Older type condos could have a higher maintenance fee. So it really just depends. Something that's considered freehold means that there's no maintenance fee. However, you know, someone buying a freehold property means that they would be on the hook for sort of any roof repairs, you know, and that could be 5, 10 plus $1,000. So, you know, when considering something that's freehold, you also want to have an emergency fund for those types of repairs. So something to keep in mind. And really going through the pre-approval process, you know, obviously asking yourself which property type you prefer is key, but then understanding those first 3 pieces will allow us to really take inventory on what types of properties can be available for the different locations that, you know, first-time home buyer is looking to get into. Okay. As we dig further into this, you know, in any property, it's important to note that when you're purchasing a property, there is something called land transfer taxes. Okay. And this is due on your closing date. So the cost of this can range. It could be 0, which is a great number, or it could be up to 3% of the purchase price. So um, every property, a location, there's different sort of calculations, but there is something good to note. There is a first-time home buyer exemption as far as you get a one-time instant credit as far as being a first-time home buyer. So if it's a property that's outside sort of Toronto, you can look to save up to $4,000 depending on your purchase price on the land transfer taxes, which is great. And then if it's inside Toronto, then there is a credit up to 84, almost $8,500, right? Depending on the purchase price. So there are many calculators online that could help someone figure out what those are. But land transfer taxes are a key part of the buying experience and something that you want to be aware of. Okay. Moving forward, okay, so this is something fun. This will walk us through a scenario that essentially I've created some really baseline scenarios here, looking at, you know, a condo purchase, all right? And looking at a condo purchase, you know, painting a picture as far as a pre-approval goes, you know, if someone wanted to buy a condo, some boundaries could be maintenance fees of $500 or less, property taxes, 2,400 annually, right? That's $200 a month with a purchase price at 300,000. The minimum down payment is 5%, so that would be 15,000. And going further, you can see a mortgage amount would be 285,000. And then there's what's called a standard mortgage insurance premium. And there are three mortgage insurance companies in Canada. One of the more popular ones is Canada Mortgage Housing Corp, CMHC. There's two others. One is Sagen, Sagan, and another one, Canada Guarantee. So these providers will basically provide an insurance that's required. So regardless of where or who the provider is, anyone putting less than a 20% down payment has to have this type of insurance. So it's a standard premium. And in this scenario, it's just under 12,000. It gets added to the mortgage. And then you can see here, there's sort of two payment amounts. I've included, a bit of a shortcut here as well, looking at, for every 100,000 borrowed, it could be, up to $550 per month per 100K or $500 per month per 100K. And I did this just to provide some range because there are many different options, whether it's a shorter term mortgage, a longer term mortgage, a fixed rate, a variable rate. This sort of encompasses the worst case scenario from a payment perspective. So I wanted to just highlight that as something to consider in in knowing what payments are. Okay. And amortization here, the payments are amortized over 30 years. So that an amortization is just how long the payments are spread over. So theoretically speaking, you bought this property, you make this payment, the mortgage would get paid in 30 years. What's different in Canada is there isn't a 30-year mortgage term. Typically, it's anywhere from 1 year to 10 years, sort of a min-max. But again, just to give you some insight on what sort of payments would look like there. Moving forward, you can see closing costs. So in this scenario, this property, let's say, is outside of Toronto. This is a good number for land transfer. It's 0. But again, when you hire a lawyer, which I mentioned one of the key players, legal fees from their side could be approximately 2,000. So we're building that in for closing costs. And there's there's a PST, provincial sales tax, 8% is this tax that's due on this $11,000. So that tax is due on closing. That can be a bit of surprise for some folks saying, hey, where did this amount come from in my closing? That's 8% PST on that insurance premium. So that's part of your closing costs. And then I always typically add at least $1,000 as a miscellaneous expense. So in this scenario one, having the minimum down payment of 15,000 and about 4,000 for closing costs, that is what you want to manage. So in total, just under 19K in this scenario, you want to have on hand and the minimum household income to qualify. So in this scenario, assuming minimal debts, someone would need to have an income of around 75,000 to make this scenario fit. All right. So that's something to keep in mind. And that math should work out to about a 4-time multiplier. And then this line was included as far as, how much will I owe at the end of 5 years? So, typical term could be 5 years. In this example, just highlighting this is what is left, assuming the minimum payments after 5 years. So just something to note. And I want to get into this second scenario here. This is a freehold type property. So this is looking at something that doesn't have a condo fee, right? Because it's freehold. And I've assumed property taxes here at 3,600, so $300 a month to budget for. I've assumed the purchase price 500, minimum down payment is 25,000. And then the mortgage request here is 475. So the mortgage insurance cost here is the 19,000 that gets added to the mortgage. So the total is just under 487. And then again, illustrating some potential payment amounts in this scenario to help people figure out their budget using those shortcuts. and amortization is 30 years. Okay. The land transfer taxes in this scenario, a first-time home buyer, the net amount is 2475. So you want to have that set aside along with some legal fees. There's this PST that's included as part of your closing, and then a miscellaneous, so about 7,000 on top of the 25 gets us to 32. So for this scenario to work out, the minimum threshold would be 32,000 on hand. Minimum household income would be just over 107,000, again, assuming minimal debts in the picture. And then finally, the principal balance outstanding after 5 years, assuming minimum payments, someone could definitely, pay more towards it to help, make this mortgage go down quicker, but that'll just give you an idea of what that is. Okay, so lots of numbers here, but hopefully creates a bit of clarity as you look at this to see what could potentially be possible. Moving forward, looking at some rule changes. So the government is obviously trying to balance, helping people purchase their first home. And there have been some rule changes that have been very positive. And basically, it allows all buyers of a newly built property, so a pre-construction property, of a 30-year amortization on what's called an insured mortgage. So an insured mortgage is that mortgage insurance premium, that CMHC, that's required for anyone purchasing a property with less than a 20% down payment. So previously, it used to be the maximum amortization for an insured mortgage, so less than 20%, would only be 25 years. So it was much harder to sort of qualify. You needed more income. So they've sort of set the bar a bit to level the playing field for someone who has a 20%. Someone with a 20% down payment could get a 30-year, but previously, if you had less than 20%, you were limited to 25 years. So now it's 30. So the playing field has definitely been leveled. So if all buyers, so don't necessarily need to be a first-time home buyer, if they're buying a new construction property with less than 20% down, can get a 30-year amortization. Now, first-time buyers can take advantage of a 30-year amortization on an insured, i.e. less than 20% down payment mortgage. So a first-time home buyer does not need to purchase a brand new property to be able to get this 30-year amortization option. So that's some good news. The other news that happened recently with prices of properties, appreciating over time, it used to be where if you were buying a property for $1 million or more, you had to have at least a 20% down payment. Buy a property for $1 million or more, you got to have at least a 20% down payment. They've changed that now based on values obviously increasing from when these rules were put out there. Now you could look to purchase a property up to 1.5 million. It technically needs to be $1 less in the purchase, but someone could purchase a property for just under 1.5 million. And the minimum down payment, the way that works is it hasn't changed. So what I mean is on the first 500,000 in purchase price, remember in the previous example, 5%, or the second example, excuse me, a 500K property, 5% of that is 25,000. So if the property is the purchase price is more than 500K, it essentially is 5% minimum down payment on the first 500K, 25,000. And as the price increases past 500, the minimum down payment is 10% thereafter. So it's something to keep in mind in planning down payments in different scenarios. Again, a good broker will help walk you through different down payment options that will fit for a first-time home buyer. Okay. And we get to next steps. So next steps really, as far as moving forward, I know I've given a lot of information here, but I think assessing your financial fitness, taking inventory of where you are today, thinking about where you want to be tomorrow. What does that look like? And I think a really good starting point is looking at a monthly budget, right? Building it, going old school, take a pen and paper out, figure out sort of what's coming in with your income, what's going out between rent or different expenses that you have. looking at what's left over every month. I think that sometimes could be a surprising exercise. So really just making the best use of your money, I think, is the first step in all of this. And then, of course, looking where you want to live, understanding what that looks like, um, and really, again, taking inventory of where you want to be, where you want to go, and then ideally it'll help you figure out sort of what next steps are to make some adjustments to help you get there. Um, this next point is how much can you comfortably afford to pay? So a lot of times clients aren't sure how much or have an idea of what they think they can afford. And what I say is test drive your budget. Pretend that you've already purchased that property. Work with a broker, look at different scenarios, and then test drive it. So, if someone's, for example, paying 2,000 in rent today, but they've done their scenario and maybe it's going to cost 4,000 between, property taxes and mortgage and some heating expenses. If your rent's 2,000, then pretend that the other $2,000 is going directly into your savings account so that you have 4,000 leaving and see how that feels over time. And that'll again help create some clarity and see what you're comfortable with as far as a budget goes. So that I really like that is a key point in this. And then really setting realistic goals on an achievable timeline. Work with an experienced broker to help really understand again where you are, where you want to go, and if there's any gaps there, figure out how you can, whether it's reducing debt or saving for that down payment. A good broker will take the time to understand your goals and help, ensure you're going in the right direction. All right. And I think we are getting close to the end of what I wanted to share. And really here, just um, want to open the invitation for people that have questions, of course, or looking for more guidance. Happy to share some guides, some workbooks. Um, you know, uh, take a scan of this QR code. You can get connected with some mortgage tools that can help you look at, what land transfer taxes could be in different areas, calculating mortgage payments. Um, just helping you have all the tools you need to get clarity on the numbers and, see what you qualify for is something that you can also do on this. So that's a cool tool that I suggest folks look at. Obviously, my email is there. My website is there for any additional resources or questions. Definitely feel free to reach out. Um, and as we get closer to the Q&A, this is a quote that I really like. It's from an author that he says here, "You were born to win, but to be a winner, you must plan to win, to prepare to win, and expect to win." So this for me really focuses on having that goal and to achieve that goal, really having a plan, help you prepare and expect to get there to it. So it definitely takes some planning, but yeah, that's something that I wanted to share with the group as well. So I think that that concludes where I wanted to leave this. And I know I think Sarah will come back on as well to take us through I guess the Q&A.
Yes, absolutely. Thank you, Shant. I thought that was fantastic. A lot of great information summarized very succinctly in a short amount of time. I also appreciated the shout out for accountants and my financial literacy webinar, so very much appreciated. Now, to our audience, if you have any questions, please use the Q&A button at the bottom of your screen and we'll get to as many as we can here in the next few minutes. And so on to our first question, which was pre-submitted by our audience during registration for the event. Okay, so we have how can parents help their kids buy their first home? Is co-ownership better than parents providing a non-repayable financial gift?
So that's a really good question, and it really it depends on sort of there's some pros and cons of parents coming on board. I've seen parents who sometimes prefer not to come on board if they have other children come on where they prefer to provide a financial gift. I mean, providing a gift obviously will help top up the resources, and parents that are comparing to someone who's coming on as an owner versus a gift. If you're coming on as an owner, then that means the parent, the debt, that mortgage debt will be on the parent's sort of balance sheet as well. Some parents prefer that. They just hand over, a gift, or they could prefer to help be on that mortgage to, co-sign to help cover off any gaps with, where that first time home buyer could be. So they they can again take ownership, help, get that person, first time home buyer to where they want to go, or they could, use the extra resources they have to top up. So there are two avenues there to help them get there.
Thanks, Shant. Yeah, I think the answer just kind of lies in it depends, which is, not the answer we kind of want to hear sometimes, but everybody's circumstances are different, right? So, I will ask you to take down your slides if that's okay as we get on to the next question, which is, I'm having trouble saving enough to purchase my first home. What do you think is the best way to save for a down payment and closing costs?
So I would say, going back to where my slides were. Sorry, Sarah, I have to take these slides down now.
Yeah, that's okay. Just to make ourselves a little bit bigger on
Oh,
folks' screen. That's
yes.
awesome.
Okay.
Thank you.
Oh, 1 second. I think there we
Yeah,
go.
that's
Okay.
perfect.
All
Thank you.
right. Um, Sort of the best way to save for the down payment. So I think the
Yes.
biggest piece is really just, taking inventory. Where's your money going every month? I think a lot of times get surprised. They have these subscriptions and everything else, and they realize like, oh my God, like I'm spending this much going over here. And, shout out to your presentation on financial literacy, that exercise with the coffee. I love that because
Yeah,
getting that latte is amazing, but then it's like, oh my God, I'm spending X amount every week. And then you compound that over time. And it's like, wow, that could take a
absolutely.
big bite into things. So, the best way is to take inventory of where your money's going. And I really like automating things. So what I mean by that is, you know, setting a priority as far as every week, maybe every Friday, you have X amount coming from your checking going into a savings or committing into a first homeowner savings account. Something small, I think, can easily be adjusted upwards as you go along. And a lot of times you forget about those automated savings and you look back and you're like, oh my God, I have 12,000 bucks in this thing. And, I put it in a first homeowner savings account. I got some benefit there when I did my taxes. So just, I think the little things can make a big impact over time, and knowing your numbers, where your money is going every month, every week is the key piece to the puzzle.
Yeah, absolutely. I think it was Albert Einstein, excuse me, who said compounding is the eighth wonder of the world, right?
Right?
So things do add up over time, and that money put elsewhere can really help you out. So thank you for
Mhm.
that.
Yes.
Um, okay, so last question here in terms of the pre-submitted, and then we'll take a couple from the Q&A, the live Q&A. If you could give only one piece of advice for someone looking to purchase their first home, what would it be?
So I think that's a great question, actually. And I would say someone looking to purchase their first home, you have to speak to someone who's done it themselves. Speak to a professional, like aligning yourself with a group of professionals, um, someone who's done it before, ask questions on how they've done it. They can working with someone who has helped many clients through this is just having someone there to give you the support, the advice, the guidance. It can be really overwhelming. So finding a mentor, I was lucky when I bought my first property. I met a mentor who said, as soon as you can afford to buy a home, go for it. And I was just like, I'm in my 20s. Like, what am I doing buying a home? That's not fun. I want to go out and have fun, right? But it's proved some significant dividends. So, get a mentor, talk to people that are in the business, talk to people that have owned a home. I mean, parents, if they've been fortunate enough to do that, that's great. But speak to someone as well that has, real-time experience that has helped many people do it, to be able to share the insights, the ins and outs to really ensure you have all the options and you're not leaving any stone unturned, or gather as much information as you can. So align yourself with a mentor. I feel like that would be a really, really beneficial step in the process.
Absolutely. And I'm sure you're super thankful to have taken his advice with the
Mhm.
appreciation we've seen in the
Yes.
GTA.
Yeah.
Absolutely. Okay, so if a first-time home buyer purchases a pre-construction condo and has already paid a 20% deposit, can they still qualify for the first-time home buyer incentive at closing? A little bit more technical, this one.
Yeah, so first time home buyer, absolutely. I mean, a first time home buyer is again, as long as they haven't owned a property before, which I'm assuming they haven't with, a spouse or what have you, absolutely. So there's benefit on the land transfer taxes. They can use their RSPs. If they don't have a first homeowner savings account, maybe they bought that property a few years ago, you better get that thing set up and take advantage of what you can for that. So you can absolutely take care of the benefits. I mean, you have a 20% down payment, so you don't need to pay that mortgage insurance
Mhm.
premium. But you can still utilize, again, first homeowner savings account, your RSPs. You'll get a benefit on the land transfer taxes as well. So the benefits are absolutely still there.
Awesome, thank you for that. Could you possibly discuss fixed and variable mortgage rates and what they fluctuate based on?
Yes, great question. So this is always one of those things, and there was a great study put out by York University prof that studied variable rates over fixed rates, and one of
Mhm.
the results were a variable rate can outperform a fixed rate over 80% of the time, and it's like, okay, what does that all mean? What are the drivers? So in a
Right.
nutshell, fixed rates, right, obviously give someone the peace of mind. Anywhere from a 1 to a 10-year fixed, you know what your payment is, you know what your rate is, very safe and secure in that regard. And fixed rates work off of what's called the bond yields in Canada. So a bond is typically, a certain time frame yields a certain investment. So, the price of that fixed rate is dependent on, the future outlook of the economy, and that's how bonds are typically priced. Or fixed rates are priced off bond yields, and bonds again is really more future predicting. So if the bond market lately with what's been happening has sort of
Mhm.
been in flux, but it's gone down lately because with the conversation with what's happening, these changes may not make the future look as bright temporarily. So it's sort of a moving target, and it's really just someone's best guess of where the economy is going. So compared to a variable rates use sort of a market rate, right? The Bank of Canada meets 8 times throughout the year. They talk about, inflation, employment, GDP, where is the economy going? So someone in a variable rate will, you know, have, 8 times throughout the year looking at what Bank of Canada is doing, and they make their announcements so they can keep the rate the same, go up or down, depending on, how things are shaping. So it it's obviously a different driver. So what drives, fixed rates versus variable? They're not connected. I mean, they can be to certain degrees, but it's yeah, different drivers will move the needle on that. So, anyways, I can go on and on, but I just hopefully that gave some basic insight and to that.
No, that's perfect. Thank you for that. And on to the next one. Are foreigners, say someone on a work visa, allowed to buy a house in Canada?
Great question. So you can. There are some taxes that are for someone who's not living here. Um, you can buy, but there is a tax that is there. So we recommend clients definitely speak to their accountant and even a lawyer to know what that tax would be. But the government has put in a tax for anyone who's not living here. There could be some nuances, but anyone who is a foreigner who doesn't have their residency, it's got to be aware of that tax, and it could affect the cost. It's a tax on the purchase price for someone overseas.
Perfect. Thank you. Now, are there scenarios that can disqualify you as a first-time home buyer? For example, owning a house from inheritance or being a co-owner of a home purchase with a family member, etc.
Absolutely. Yes. There are some definitions. I think on my Instagram, I put something on there as far as defining a first-time home buyer. But, if you own a home currently that was inherited or, someone is co-signing for someone, that will absolutely impact being a first-time home buyer, unfortunately. So you really want to assess what that is. I mean, in scenarios where someone is, spouses and there's a breakdown, in those scenarios, it could be looked at someone who is a first-time home owner again, but someone who is currently owning a property, even if they're, co-ownership, kind of how we talked about parents, or someone else being on board, that would unfortunately, disqualify them from being a first-time home buyer.
Perfect. Thank you. Now, I'm still not clear on the exact role of a mortgage broker. Is it to guide the buyer to help them navigate the process? Do they have a more specific, tangible role? Is a mortgage broker required or simply recommended?
So a mortgage broker is recommended, but as far as options and how people can acquire mortgages, they can walk into their bank, of course, to speak to someone there. That's what I was when I first started out after I graduated. So you could walk into your bank. You can also speak with what's called a mobile mortgage specialist, which is employed by the bank. So again, they're still an employee of the bank. Um, and then you can really get a broker, which in my opinion is the next generation of how homeowners are acquiring mortgages. I think in Canada, over 50% of first-time home buyers are using mortgage brokers, and that trend is continuing. So it's definitely not a requirement. It's recommended only because, again, a broker is not an employee of that provider. So think about going in to buy something, even if you want to use the analogy of a car, let's say, walking into a dealership to purchase a car, it's very unlikely that that representative would say, hey, you should go and check out this provider because they have a newer model, better payment feature for you. So it's really just giving clients the education needed at a higher level because they're a specialist and they can provide different options to borrowers, not just the option that you see on your phone and think naturally, I just want to go here. So it's really, again, it's not definitely mandated, of course, but it's required. I think there's definitely lots of value there for the reasons I've mentioned in the presentation too.
Yeah, I completely agree just because you'll have more access to options outside of that one institution.
Yeah.
So I think that's fantastic. Lastly, what's the cost benefit of a 5% minimum down payment versus the standard 20% down payment?
So that's definitely a technical question. The cost benefit, of course, is, if someone has the resources to get to a 20% down payment, then definitely not having to pay that one-time insurance premium would be nice. But as far as, waiting to save that versus trying to find something that suits your needs today with using the resources you have, if it allows you to get your foot in the door in the market, then paying that insurance premium could be well worth it if it allows you to start, being a homeowner, gaining equity. The hope is that the property values, over the long run will continue to increase. So it's, cost benefit, understanding where you are, where you want to go. Like, can you get there? What your situation is today, even if you have to pay the premium, it's not a bad thing. It's just what works best. Hopefully that answered the question.
Thank you for that. So that appears that it's all the time we have today for questions this afternoon. To our audience, we received a lot of questions today, and we apologize if we were not able to get to yours. We hope that you found this webinar series useful and that you enjoyed today's presentation. So on behalf of U of T Mississauga, I'd like to thank Shant for his time and thoughtful responses to the questions from our alumni audience. Shant, do you have any parting words you'd like to leave with us today?
I just want to thank everyone for their attention, for joining this today, take the initiative to learn more. Yeah, and I'm so thankful to have the opportunity. And there's one quote that I really love, and that is, a goal properly set is halfway reached. So I thought I'd leave off with that, sort of some words too.
Absolutely. I love that. All right. So, everyone who registered for today's event will receive a link to the recording in their inboxes in the coming days. Along with the recording, you will have the option to take an online post event survey, and we do hope you'll take a couple of minutes to complete it, as your feedback is helpful for planning future events. And if you enjoyed today's webinar, be sure to check out the upcoming events listed and more on the UTM alumni webpage. Thank you again for joining us, and we look forward to hosting you again at another U of T Mississauga webinar soon.